Hey, how are we doing? Welcome to Your Successful Retirement. Last time we talked about what you should be thinking about doing with your portfolio, or maybe doing with your portfolio when the market's down. And that's obviously a concern of most people. The market's down. What should I be doing? Today, I want to take the opposite. I want to talk about what you should be thinking about when your portfolio is doing well. And if you pull 10 people off the street, you get 10 people saying, I'm not going to do anything. My portfolio is doing well. This is exactly what I want it to happen. This is where we want to go. We want to go deeper with this. This is great. And that can be dangerous. There's two emotions that drive our actions as humans. It's fear and greed. Last episode, we talked about fear and how fear can really screw things up as the market goes down and you do this knee-jerk reaction, you sell, and the market comes back and then you buy back in at a higher price. Is really bad. That's not a good thing to do. Greed is probably the more powerful motivator, believe it or not, and the more dangerous, because fear can hold you back. It can slow down your progress. Greed can wipe it out completely if you're not careful. There's an old adage on Wall Street. To me, I don't know, it's vulgar. It's very, very coarse, but if you've spent any time near Wall Street or talked to people from Wall Street, they'll tell you this is bulls make money, bears make money, pigs get slaughtered. And that really is true. Is if you get too greedy, that's when you get in trouble. It's always good to leave some money on the table. And I want to talk about that today. And I'm going to use some really extreme examples. And then I'm going to talk about kind of how we can temper that, how we can avoid that, because greed is the hardest one. Fear is going to keep you up at night. It's difficult sometimes to counteract, but greed, my gosh. I'm going to give you my first greed story. Is back in 99, 2000, the tech boom, there were these companies called, I think they were Celex is what they were. They were companies that resold telephone company services, usually to business, but also sometimes to consumers. They would come in and they'd say, look, we're going to be your new phone company. You're going to pay us and everything else. But they'd wind up putting a switch in the local telephone office, whether it was Verizon or whomever, and they would make money by charging, and then Verizon, 9X, Bell Atlantic, whoever it was at the time, Pac Bell, would sell them the services or the use of equipment on a discounted basis. And they were trying to make money. And there were a couple of these firms that did well regionally. And I had a client that worked for 9X for years. He was in corporate sales for 9X and then started working for this other company. And he was fairly high up in this company. And I remember sitting down with him and his wife in his kitchen. And he had a house that was, I couldn't imagine being in this house. His lot was shaped like it was in one of these McMansion developments. And it was shaped like a dome, like an igloo is where, at least it seemed that way. So you hit the driveway and your first incline is probably like 75 degrees up. It was like, holy cow. And then it rolls up to the top and flattens out at the top. But my gosh, if you tripped and fell off the front steps, you'd roll for 100 yards into the street. There was no way of stopping just because you accelerate as you went. But anyways, sitting in their kitchen. And at the time he had, now again, this is 1999, 2000, somewhere in that range. He had $1 million of stock options. They were in the money by $1 million. So if he cashed them in right now, it was $1 million less taxes. And I knew this, and they had been growing over time. He had been working there for 3 or 4 years. They had been throwing these stock options at him as part of compensation, which is great. And I said, look, why don't we exercise half of them and take the $500,000 and just walk away with it? Again, this is 25 years ago. This is a lot of money. And he looked at me like I had 4 heads. I'm not doing that. This company's going to triple in the next 2 years. I understand that. I understand that. But maybe we take some money off the table right now. And we're going back and forth. And his wife is making dinner and taking care of the kids. They had 2 younger kids under 10. And she comes over and she says, wait, what are we talking about? And he says, well, I get these stock options. She said, what are they worth? He said, they're worth $1 million today. And what's Dennis recommending? He's recommending I cash in half. And she said, Steve, that's $500,000. Because I know, in our pockets. So I left. She worked him a bit more. He exercised the options. Inside of about 18 months, the company was completely bankrupt. He was the only person there to get money out of that company. Every single other person that received these stock options never bothered cashing them in. They never cashed them in. They got greedy because they believed, just like Steve believed, these stock options are going to triple in the next 2 years. And my $1 million is going to turn to $3 million. I'd be stupid not to. And when I looked at him and said, I said, look, the half that's going to triple is going to be 1.5. It's still a lot of money, but if it goes to zero, we're protected. And I didn't know it was going to zero. Don't make me, I don't want to mislead somebody in saying I could see the stock market crash of 2001. I could not. I knew there was problems. It was the era where I love this. Every once in a while you get this, and I always listen for it. It's not always this loud. It was very loud in 2000 when you had internet companies that weren't making money. Like not even close to making money. Amazon still was grossly unprofitable. Every single internet company or EMC was making money because they were selling equipment. But software was making $0. They were losing money, hand over fist. And the mantra was, and usually this is said by a couple of people, but this was said over and over and over again during that time. You don't have to make money to make money. Yes, you 100% have to make money to make money. You cannot operate on constant losses forever. You have to have a plan to actually make money. And these companies had no plan to make money ever. And that's why that crash happened ultimately. So that's an extreme look of greed. There was another one. And who remembers Enron? Do you remember Enron at all? That was 18 years ago as I record this. Enron was a energy trading company. They would trade different futures and things on energy and stuff. They were quasi oil industry players. And Ken, I'm trying to think the name of the CEO is Ken something. I can see him. I can't think of his last name. And it turns out that they were a ferociously successful company. They were reporting all these great profits and people were buying. The stock was going bonkers. Turns out it was not doing so well at all. They were lying, they were hiding things, they were losing money when they were making money, things like that, really bad stuff. And Ken Lay was the guy's name. Ken Lay was the guy. And in 2007 rather, all of this comes to light and the company just folds. It just disappears because there's nothing there. It's kind of like FTX. Remember FTX a couple of years ago, Sam Bankman-Fried, they were the exchange for crypto, and he was taking money from client accounts and using it for other things, which like you're not supposed to do, and then lying about it and then doubling down on that lying and doubling down on the taking of the client funds. Same problem. I think it might still exist, but it's very small at this point. But Enron just blips out. And the difficulty was that there were people, a number of people, it may have been a majority of people, I forget exactly, who worked for the company that their entire 401k was invested in Enron stock because it kept growing. So why wouldn't you buy Enron stock? You believe in the company, and it kept growing and growing. And I remember there was one story back in the early 2000s of a janitor that worked, again, early 2000s, a janitor that worked for Enron. He was just like the corporate janitor guy, and he had $1 million 401k. Holy cow. And then bloop, it was all gone almost in an instant. That's the type of power that greed has. It puts those blinders on of, I've got to double down again. It's the same reason people stay at the craps table in Vegas, is there's that greed. Even if I'm losing, I'm focusing on the next thing. So I want to cover two other stories that I have personal relationship with that I watched. I mean, both of them are back in in the tech boom of the late 90s, and both of them were absolutely tragic, and there was nothing I could do to stop them. And to some extent they haunt me to this day. It kills me. Is we talked last week or last session about people that sell at the bottom. I've had clients sell at the bottom, and it absolutely breaks my heart. People ask me, when the market's down, are you losing sleep? Yes, I am. Are you losing sleep because of the market? No, I'm not. I'm losing sleep because the clients that may consider selling, and I know that's the worst thing for them. It has the potential to financially destroy them, and that's concerning. Same thing here with these two stories. Is the first one is, again, this is 99 2000. I was on the cutting edge of internet chat boards and things like that, and I was on this one chat board, and there was this guy, I forget his internet handle, but his name was John. He lived out in the Phoenix area of Arizona, and he was like a truck driver or something, is what he did for a living. He wasn't some big executive. He was just some regular guy. And it's before 2000 when this story starts, because he was also, he was kind of a hoarder because he was worried about Y2K. Remember Y2K? Y2K is going to wipe everything out, and it didn't. He was a big hoarder for that. Is, I'm going to amass all these things so that I'm going to be okay when everything goes to heck in a handbasket on January 1st, 2000, which didn't happen. But he was also a tech junkie in terms of investments. And he kept telling people on this board these great trades he did. And he would buy company X at one price and he'd sell it at a substantially higher price. And then he bought company Y at that price and he sold it at this price at a substantially higher price. And it's very similar to when you have people talk about, well, I bought my first house in 1972, and they go through the iterations of, I bought it for this and I sold it for this, and I bought the next one for the same price and I sold it for this. And you go all the way through and you realize the first house and his current house are worth the same. He just moves sideways the whole time. Same thing with John, is he was just moving sideways in these tech companies, but he stayed 100% tech. And that's all he had for investments. It was everything he had. And he was in his late 50s at the time, and he was gearing up for retirement. And myself and a couple other people just kind of on the board were like, hey, John, you may want to back off just a little bit, just a little bit with this. Don't go too crazy. Maybe buy a bond, maybe put money in the bank, something to temper this, because you want to be careful. And there was a profanity filter on the site we were on. Thankfully, he not so politely told us to bleep off, basically, that he was smarter than us, because, especially me being in this industry, I'm smarter than you because I'm making more money than you. John, it's not about that. Is, I have years of experience. Please, 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 just be careful, be careful, be careful. And I will tell you, I don't know what happened to John. I don't. And he'd be in probably his 80s now. The market crashed in 2001, and he was so personally crushed and embarrassed by that he just stopped posting on that internet bulletin board. He was gone, because all of those things we were telling him were suddenly true. And he was so afraid, especially the way he treated me and a few other people, that we were going to come back and just say, ha ha, I told you so. And somebody else might have. I wouldn't do that. That's not in my nature, that ha ha, I told you so type stuff. I'm there to fix people's problems, not judge what they did. And maybe there was a way out for John. I don't know, but he got wiped out over the course of maybe 12 or 18 months, just completely wiped out to the point where he disappeared. Thankfully, he had all those excess Y2K supplies, so he was possibly okay. But he was thinking of retiring from his menial job, and he had no other assets but this portfolio, and that breaks my heart. And I still think about it to this day. Simultaneously to all of that, I had this new client that happened to work at the power plant that's across the bay from our office, which is now defunct, and another stock jockey. And he has this portfolio and he comes in, he sits down. This was so long ago as I was in a different office across the hall from where our offices are today in the same building. And I looked at his portfolio and very aggressively invested. And I said, I don't think this is the best thing for you. I think that you should diversify more. I think that going in this direction can be dangerous for you. And he said, oh, okay, let's try that. I said, be aware. I said, tech has done very well recently. If it continues doing well, you're not going to be happy with me. And I want you to understand that what I'm doing is not buying this, because at some point that is going to stop. And I don't know when that time is. I didn't know it was sooner than later, but at some point things are going to flip. You need to understand that if between now and that flip, whether it's a day or a year or 3 years, you're going to be a little frustrated with me. And then it's going to flip and you're going to get it. And you're going to say, oh, now I understand why Dennis is doing what he's doing. And about a year and a half later, he called me up. He's like, I'm all done. I'm all done. Yeah, I think you're an idiot, because the market's up this. My old portfolio would have been up this. You're wasting my time and you're costing me money. And I said, I understand. We talked about this when we talked about the portfolio. As long as tech is doing well, you're not going to be happy with me because of where you came from. No, I get it. Nope. I'm done. I happened to talk to him about a year later with the tech crash, just checking in, really just checking in. I bumped into him somewhere and I said, hey, how's it going? Yeah. I got killed. I said, how bad? And it was something like 75, 80% wipeout, because he went right back into this hyper high risk stuff, individual stocks and things like that. And we'll deal with that in a minute, just why we don't want to do that. And that can be an extreme example, but it was all this tech stuff and he got greedy and he kept trying to go back for another. Let's roll the dice again. Let's roll the dice again. Let's roll the dice again. I've been winning, ergo I should keep winning. And that's not necessarily true. Is the stock market, it's not random, but just because you won yesterday has no bearing on if you're going to win today. Has zero bearing on that. And it's dangerous. Is with both of those gentlemen, they made a tragic error. I worked with a guy years ago, and he had a saying, and it is so true, is don't confuse luck with skill. There's also a similar thing. I'd rather be lucky than good. I would much rather be good than lucky. Luck runs out, good doesn't. I've been lucky at times, definitely, no question, but I'd rather be good than lucky. I'd rather be skilled than lucky. Is confusing luck with skill means, oh, this went up, ergo I must be smart. No. It can go up and you can be dumb. It can go up and you can be dumb. It goes back to, was it Schwarzkopf or somebody when Iraq invaded Kuwait, and we went in and freed Kuwait, there was, may have been Rumsfeld. They were, talking to him at some press conference or something. And he said, well, he's like, we don't, they asked about what's the biggest concern he had. He said, well, we've got our known knowns, things we know and that we know them. And we've got our known unknowns. There are things we don't know, and we don't know them. And I can live with both of those. The thing that keeps me up at night is the unknown unknowns. There are things I don't know, and I don't know that I don't know them. And that's the fear here, is being lucky versus skilled. Is you're just buying something and basing your opinion of that based on the success or failure of the stock or of the investment itself. And that's very dangerous. What you want to look at, what's the solution, is let me tell you what we do. And what we do is something that a lot of people preach, not always execute. And I think this is something that can help. because it ignores greed. It also ignores fear. We touched upon this last podcast as well. Is we kind of subscribe to a model called asset allocation. It was created by this guy Roger Gibson. Gosh, it's going to be back in the 70s, so it's going to be close to 50 years ago. Roger Gibson's going to be old by now. I still see Roger Gibson as a 35-year-old guy on the dust cover of the book. But Roger Gibson I think he was a professor somewhere, and he started doing all this mathematical analysis of portfolios. And one of the things he found was that if you take a mix of investments, and we'll call it investment categories, not specific investments. So, large versus international, stocks versus bonds, U.S. versus international, large versus small, and you figure out a percentage for each of those. And if you just try to maintain those percentages over time, it's going to cause you to always sell a little bit of your winners and buy a little bit of your losers. So think about this. Let's say it's, is one of your categories is large U.S. companies, S&P 500. And you're supposed to have X percent, whether that's 1% or 99% in that category in January of 2023. Let's call it 20%. That's just a number, not meaning anything, 20%. And at the end of 2024, it's no longer 20% of the portfolio because it's done so much better than all the other investments. It's maybe 23, 22, 24, maybe even 25. What Gibson said was, on a regular basis, and he tested a bunch of different models, you should take the excess, that extra 2, 3, 4, 5%, and move it out of that category and find a category that's down by 2, 3, 4, 5%, or maybe it's multiple categories, and reallocate that money into those other areas. Now, it's not fun to do. It is not fun to do asset allocation because when things are up, you have to sell. And when things are down, you have to buy. And that's no fun. I had a gentleman, the first of this year, the first of 2025, knowing this was an administration change, he called me up and he said, I think we should make a change with the portfolio. And this happened ridiculously rapidly. And it's by no means any sort of endorsement of this. I just use it as an example of how this can change this quickly. His assumption was, with the new administration being very pro-American, that domestic investments were going to do very well. International were going to do very poorly. That, is the Trump administration was going to wipe the floor with the rest of the world, which he still may do. But in the first 4 or 5 months of 2025, internationals have done by far better than domestics. Now, they were lagging for at least 2 years. I have to go back and check how long it's been that domestics have done better than internationals. They're getting their clocks cleaned this year. You've got to be careful of that greed. That greed told him things have been doing well, ergo it's got to keep doing well. And I've got a president that I think is going to be helpful to the U.S. economy. Ergo, we want to buy more of that and sell some of that. We actually did the exact opposite for him. He was okay. We had a conversation about it. He understood what I was doing. And knock on wood, things reversed that quickly. They tend not to do that. It's not an endorsement of anything, but it did very well. And those are the type of things that Gibson is talking about within asset allocation. It forces you to sell those winners when you don't want to. If something doubles, you go, let's buy more. Again, going back to some analogies we used last podcast, is if you're buying peanut butter for $5 a jar and it goes to 10, are you buying more peanut butter or less? You're buying less. Same thing with investments, is if that doubles in value or grows that much faster than the rest of your portfolio, it's time to take some money off the table. It's time to take some money off the table, like this client, like my old client Steve back in 2000 with his telecom company, taking that profit. The last thing that Gibson found, and I find this fascinating. I don't understand the math that much. I understand the concept. I don't understand the math behind it. It's very high level math. I'm very surprised this guy's never won a Nobel Prize, because if you talk to the majority of investment firms out there, people that do on a corporate basis kind of what we do with asset allocation, whether it's a Schwab or a Fidelity or a Fisher or whomever, really subscribe to this model. And it's I look at modern portfolio theory. I'm going to go geek out for a minute or two, and I apologize. Modern portfolio theory that I learned in school back in the 80s was invented in the 50s, and all those guys got Nobel Prizes. And I don't believe Gibson's got a Nobel Prize for economics. He probably deserves one. Thinking of how we look at it and how he proved it with math. But one of the things he proved was, for a given risk level on a portfolio, by implementing asset allocation, it actually reduces the portfolio fluctuation. I don't understand the math. I understand the logic. Is if you bought a basket of investments and never touched them, and again, large U.S. companies in 2023-24 go up like gangbusters, and you never sell and take some of that profit, when it comes back down, it's a greater percentage of the portfolio that's taking that loss. And I understand that concept. And it's very important that you can actually temper the fluctuations in your portfolio without changing the risk profile, the stock to bond mix and things like that, just by implementing asset allocation. That's why I don't understand why more people don't do it themselves. I don't understand why more people in my industry don't subscribe to it as strongly as I do. I know that if you look at people in my industry, you look at the big players, you look at the people on TV, and when things are down, you just stay with it, stay diversified, all of that. And I think I mentioned this last podcast. I got an email recently from Charles Schwab, and we clear all our investments through Charles Schwab, and Charles Schwab has an entire division dedicated to people like me, advisors. And back in, I think it was early April, there was a 2-day period where the market dropped by somewhere around 10%. I forget exactly how much it dropped. It dropped a lot in 2 days. It was a Thursday, Friday. It was like boom, boom. It was ugly. It was horrific, not fun. And Charles Schwab said their advisor servicing division saw the 2 busiest trading days in their history on those 2 days. And I'd like to believe that my peers were buying during those 2 days. I don't believe that for a second. They were running the same fear greed roller coaster that every other person runs. It is vital. So I will say this: asset allocation can help. It can help a lot. It can get rid of the fear times, in terms of forcing you to buy when you don't want to buy, when you want to sell. And it really gets rid of the greed times, is when you want to keep something is the last thing you want to own. At least according to Gibson, in my belief, is asset allocation can really be a big game changer. Finding somebody, if you're unable to do that yourself, finding somebody that can do that for you, that will do it consistently, is vitally important for your portfolio. So that's what I have today. I really appreciate your time. If you get a minute, jump down in the podcast app you're in and give us a rating. Rate us 5 stars. Make sure you share with your friends. We want to get more listeners at all possible. Leave a review. If you have questions, you can jump into the show notes. Send off a contact through either social media or our website that are both linked down there to allow you to contact us for whatever question you might have or an idea of a future podcast. And with that, stay safe out there.
Thank you for listening to our podcast. Remember, the views expressed are not necessarily those of Successful Money Strategies. All content is for educational purposes only and should not be construed as an endorsement of any third party or their views, or as a solicitation or offer to sell securities or provide investment, tax, legal, or consulting services. We believe the information presented to be reliable, but it is not guaranteed for accuracy or completeness. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. Always consult with a qualified financial advisor before making any investment decisions. Past performance is not a guarantee of future results. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request, or at the SEC's Investment Advisor Public Disclosure website, https://advisorinfo.sec.gov.